you do see treasuries falling ahead of that 30-year auction. Longer dated debt has been a little scarier for investors, if you will. You mentioned the dollar a little bit earlier. I want to pull the one-year chart up of that as well, because it's not been sideways, it's been straight down since you've seen the heights. What is this telling you, and what are the ramifications?
Essentially, we are repricing from a unipolar financial system to a multipolar financial system, right? And so the U.S. is trying to gather their allies under its banner with tariffs and with closer cooperation. But the tariffs are not going to raise enough capital for the deficit to be sustained. So eventually the choice is for the U.S. Treasuries, to do some level of austerity and spending cuts. And we do see those coming in 2026. And the choice for the Fed will be between price stability and financial stability. And so far, what we see across central banks around the Western world is that they're choosing financial stability over price stability, so they're letting inflation run a little bit above target, which means, FX depreciation. And it means that investors need to own hard assets. So gold, private credit, private markets are okay, but they're very tight right now. And also investors should be wary of further rounds of volatility. We're in a very volatile world. So right now, it's much better to stay a little closer to home and position for upside in markets that have more room to run, like equities or commodities, for example.
That's really interesting, Alberto. And just to make sure I'm understanding you correctly, so you do see some sort of austerity, maybe in the form of spending cuts, coming to the U.S. in 2026. That's your timeline?
Eventually, that's going to be a need. And you can see that the voters' polls are already showing that voters don't like fiscal profligacy anymore as much as in the past. I think the UK is an advanced version of where the U.S. will be. Obviously, the UK has weaker dependence on commodities, dependence on imports. It's a weaker fundamental situation, but it has been doing austerity and is struggling to raise taxes, right? To raise tax revenue. So the U.S. is in a better situation and can continue to spend at a clip of 6-7%. But eventually, you have to find more ways of funding the Treasury, or you have to cut spending, or you have to push rates lower, real rates lower, and depreciate FX. So it's going to be a combination of all these three